All right, let's talk about the biggest event to hit the market in the last 18 hours. And no, it wasn't some whale dumping their bags or old recycled ETF news. This was completely different. This was a massive global shockwave that sent Bitcoin spiraling down towards that $90,000 floor, and the whole thing started with a single move in Japan.
Okay, so let's get right into it. This is the number that really tells the story. $500 million. That is how much got liquidated across the entire crypto system in just 18 hours. And this wasn't some surgical strike, oh no. This was a tidal wave that just slammed into Bitcoin, Ethereum, and XRP, wiping out leveraged positions left and right.
So what on earth caused it? Well, you can throw the usual suspects right out the window. This wasn't one massive seller tanking the market, and it wasn't some delayed reaction to a news headline. The real trigger was way bigger, and it came from completely outside the crypto world.
To really understand what just happened to your portfolio, you got to look beyond crypto, into the world of traditional finance. Specifically, a huge decision made by the Bank of Japan to raise interest rates. That single action kicked off a massive chain reaction that started tightening the screws on money all over the globe.
And that right there brings us to the absolute heart of this explainer. This is the financial phenomenon that just rocked our world, the Yen Carry Unwind. Now, I know it sounds complicated, but trust me, the idea behind it is actually pretty simple, and it's absolutely crucial you get your head around it.
So here's how this powerful global money flow works. For years, big-time investors have been borrowing Japanese yen at almost zero interest. It was basically free money, right? That's the carry trade. They take that super cheap cash and plow it into riskier things that offer higher returns, like stocks or crypto. But when Japan raises its rates, the yen gets stronger, and suddenly that loan is a lot more expensive to pay back. So what do they have to do? They're forced to sell their risky assets, or crypto, to get the yen to pay back those loans. It's a massive global deleveraging event.
And here's the bottom line. This had nothing to do with crypto fundamentals. This was a macro de-risking signal, plain and simple. That flood of cheap money that was propping up markets all over the world, it suddenly started getting sucked back home to Japan. And for crypto, that meant the river of liquidity that was supporting the market just got dammed up, pulling the rug right out from under us.
Okay, so now let's dig into the fallout. With all that cash getting pulled out, the market's reaction hasn't been a simple everything goes down kind of sell-off. Nope. Instead, it's become what I can only describe as pathologically polarized. Capital is scrambling, it's creating chaos, and it's leading to some really strange winners and losers.
And you can see the top-level damage right here. I mean, Bitcoin is in an absolute dogfight to hold the line at just under $90,000. But look over at Ethereum. It's hovering around 3,030, and it took an even harder punch over the last 24 hours. The pain was definitely not spread out equally.
But this is where things get truly weird. In one corner, you've got Terra Luna Classic absolutely exploding, up over 70%. And in the other corner, you have these high-speed layer ones like Sui and Aptos just bleeding out. This isn't a market where the tide lowers all boats. Money is desperately chasing very specific stories, not just broad tech ideas.
So why the crazy split? Well, Lunk's pump is pure story. It's all speculation that the legal mess around Do Kwon is finally ending, creating this kind of clear-the-air rally. Zcash is up because, well, when there's chaos, some money always runs to privacy coins as a safe haven. Meanwhile, the projects that are all about speed, like Sui and Aptos, they're getting hammered because there's just not enough money floating around anymore to support those high-growth stories.
All right, so that's the diagnosis. Now let's talk strategy. We are heading into a very low liquidity weekend, and we absolutely need a game plan. So think of this next part as our war room briefing for the next 48 hours.
Look at this number, 23. That's where we are on the Crypto Fear and Greed Index. Deep in extreme fear territory. Now, textbook thinking says this is when you buy, right? Be greedy when others are fearful. But with this huge macro storm from the Yen Carry Unwind still raging, you have to be incredibly careful. So here are the battle lines for the weekend. For Bitcoin, $89,000 is the line in the sand. It is the absolute must-hold level. If that breaks, a drop down towards that 74,400 zone becomes a very real possibility. For Ethereum, that psychological barrier of $3,000 is everything. The good news? It looks like whales are quietly soaking up this dip, seeing it as a buying opportunity.
So while retail traders are hitting the panic button, let's follow the smart money. The hot sectors right now are stablecoins, real-world assets, and all the infrastructure that supports them. But on the flip side, you've got what I'm calling the doomed sectors, these Bitcoin Treasury Stocks, or DATs.
These are the companies holding tons of Bitcoin, and anyone who bought in late is now trapped with an average cost of around $107,000. Ouch.
And this really shows you the long game being played. BNY Mellon, one of the oldest banks in the world, just launched a Stablecoin Reserves Fund. The CFTC just made a ruling that could open the door for trillions in future ETFs. So while the market looks like total chaos, the giants are quietly laying down the railroad tracks for the next bull run. Meanwhile, those DATs are entering what I can only call a brutal Darwinian phase.
Okay, with all this madness, you need a simple dashboard to stay grounded. I'm going to share with you the 2 key metrics I'm watching like a hawk right now, and honestly, you should be too. They cut through all the noise and tell you what's really going on under the hood.
First up, Bitcoin dominance. It's sitting around 59% right now. This chart is absolutely critical. If Bitcoin's price starts moving sideways or even drifts down a little, but you see this percentage start to climb, that is a massive warning sign. It means money is fleeing the altcoins and running back to the relative safety of Bitcoin. If that happens, prepare for what we call altcoin destruction.
Second, you have to use the Fear and Greed Index as your emotional filter. We're at 23. Extreme fear. If you suddenly see this number shoot up into the 40s or 50s, but the price of Bitcoin hasn't really recovered in a strong way, be very, very careful. That is a classic bull trap. It's a sign of dangerous, baseless FOMO creeping back into the market.
And finally, don't forget to look at the calendar. We have events like this upcoming CFTC nomination deadline on December 8th. Now, this isn't a direct price bomb, but it's a huge signal that regulators are gearing up for their next moves now that spot crypto is a thing. And let me tell you, more regulatory attention is not always a bullish sign.
So, that's the lay of the land. We've got this massive macro force from the yen unwind, a completely fractured and emotional market, and we have these huge institutions making quiet, long-term moves in the background. It all brings us to the single most important question you have to ask yourself right now. In the face of all this, how do you stay rational?
And I'm just going to leave you with this thought, because it has never been more true than it is today. Right now, this market is a machine designed to shake out the impatient and to reward those who can stay detached from the fear and the FOMO. Analyze the data, understand the big picture forces at play, and make your decisions based on logic, not panic. Stay safe out there.